How has the world changed in 7 years for finance and accounting? Hi, everyone. Welcome to the Biz Dev Podcast, the podcast about developing your business. I'm David Baxter, your host, and I am joined, per usual, by Gary Voigt. How's it going, Gary?
It's going well. How you doing?
Your office is getting put together behind you. Is that Austin Powers behind you?
Yes, there is an Austin Powers and a Dr. Evil and a Kylo Ren and Dwight from The Office. There's a bunch. Maybe we'll do a bookshelf tour one of these episodes. But yeah, it's coming together slowly. I still have this area to finish.
The look on your face is priceless, especially with this new whatever you're growing here is. I know it's good radio to talk about Gary's facial hair, but it looks like it's attacking your face. Yeah. So it's well done. Well done. You glued it nicely.
Appreciate that. Thank you.
More importantly, we are joined by Kristian Marquez, who is the CEO. And are you founder? Are you not the founder? No, you are not.
I'm the founder.
Yes. You are the founder. Okay, so that does not say that on my thing here.
Oh, so good to know.
Good to know. You are. It says president, CEO, and CFO, but not founder. So and that matters. That matters. More importantly, you're in charge of FinStrat Management Inc. So I'm going to ask you the 30,000. Well, first, hello. Nice to have you. I'm really bad at doing that.
No, good. Thank you for having me on.
Oh, sure. Glad to have you. Okay, so give me the 1,000, 3,000, 30,000, whichever height you'd like of what FinStrat is.
So FinStrat Management is accounting and finance for early stage companies and investors. More specifically, we provide fractional CFO-led end-to-end accounting and finance services for other founders, predominantly B2B SaaS venture-backed companies, as well as angel and venture capital firms. And so the way I describe it is we're a bit unique in terms of our value proposition. We operate at the intersection of shared interests between founders and investors. And to date, I've not yet come across another firm like ours who is doing that.
Nice. Okay. So tell me a little bit more about that unique thing. So because you work with investors and founders, you have a unique view, lens, however you want to say that, into that world. And so that's very cohesive, very useful, very helpful. How does that help people?
Yeah, it's helpful so if we start with founders and our value proposition, I can distill it into two things. Thing one is what I describe as fix it once. The other is assisting monetize their business.
I have a question that I think you're uniquely capable of answering. So when a company is running on a runway, and for those who don't know what I'm talking about, a runway means you have someone else's money and you're spending it for a period of time until you're out of said person's money, investors, angels, however you want to calculate that money. But you are spending other people's money to get your idea off the ground, hence the term runway. When someone is in that phase of their company, is accounting very different? Because there's no money coming in, right? You just have a big balloon that you're slowly leaking air out of until you crash.
So the answer, a couple things. One, it's important to identify stage. And what I just heard you describe is, God bless you, what I just heard you describe is identifying product market fit. So you're just getting started. And if you're identifying product market fit, there's a potential that you don't have reoccurring revenue, i.e. your revenue is sporadic. And so it's important to highlight that because for any company that has reoccurring revenue, 100% without question, accounting is crucial because the only way that you're going to be able to calculate a very important metric, monthly reoccurring revenue, is because you're appropriately accruing that revenue. And so just a quick example, if someone sells 12-month subscription or your 6-month subscription, anything greater than a month, if you go the traditional QuickBooks route of just creating that invoice for multiple months, QuickBooks is going to put all revenue in that 1 month that the invoice is dated. But that's not right. It needs to be spread out for the months of service. And so that's, I'm oversimplifying, but that's effectively what accrual accounting is taking that portion of revenue greater than a month and putting it on the balance sheet and then peeling it off when it's supposed to be, when it's being incurred. And so in the absence of that, you see what looks like a cardiogram. Your revenue is a reflection of when you're actually sending invoices out the door, not when you're actually incurring the revenue. And so to a founder, but definitely for an investor, that's important. It's important because it's a metric that many people in the venture capital space who are investing in reoccurring subscription type businesses assess. But back to your question, if they're still trying to get product market fit, i.e. throwing spaghetti against the wall to see what their business is going to generate consistent revenue, I can make a case that accounting is less important. But the only reason then I would pause is because your comment about, well, what does your runway look like? And so, even if you're selling deals sporadically, you have to ask the question, is it just good enough that I go to my bank account to see what my balance is to make a decision of whether or not I have enough runway? In my experience, the answer is it can be done, but I don't like that answer. I don't like that answer, especially if your capital planning or capital spending is going to change. If you're making new hires, if there's just variables that are not currently reflected in what your bank balance is to help you determine whether or not you're going to maintain that same rate of decrease.
Now you're using very technical, big terms, which, I mean, that's state of the art kind of stuff for you. The question I have is, do most of the founders have a clue what you're saying? Or are you also a teacher to explain this stuff? I mean, I guess most of your people probably have money from somebody already. They're not just getting started. They're not living off of, aunts and uncles.
So we find that we're a good fit when a company has about $1 million in annual reoccurring revenue. That said, we have a handful of clients that are pre-revenue. In those instances, the pre-revenue businesses, they've hired us because they already have VCs on their, or as investors. And those VCs have an expectation that their financials are going to not only be prepared accurately, but they want them to have access to a fractional chief financial officer who can assist guide strategy. And so to answer your earlier question about, how do we assist a founder connect the dots? I mean, a lot of times it's just visuals, dashboards, models. We use specific tools to manage cash flow on a short-term basis. And not only will we pull that up and share a screen on a weekly call, but you have a fractional CFO who can explain what they're looking at. And so in that regard, if you come back to what I was sharing earlier, assisting a founder monetize their business, everything I just described are steps along the way to get there.
I'm thinking of my account. I am not a finance guy by any stretch of the imagination. It's funny. My business group talks about how I'm the example when it comes to cash, because we're cash only. And they make it sound like it's something grand, but it's really, I have no other way of measuring success for me. It's just, do we have enough cash in the bank to make payroll? Sweet. I'm good. Right. That's it. I don't have anything fancier than that. But as a founder, all the stuff you're saying, I mean, conceptually, I know what you're saying, but if you ask me to explain my own business in those terms, deer caught in the headlights. I have no idea what you just said in a practical way.
So here I'm going to provide an example that I think will resonate with us and your audience. So everyone is familiar with return on investment. Sure. And simplest term would be, if you spend $1, you want to make back at least, let's make up a number, $3 in return. 5 is even better. Maybe I can argue actually why $100 maybe is too high. More on that in a moment. But in simplest terms, it's basically saying, all right, I'm going to spend money on something in the expectation that I'm going to make more money back. All right. So in that example, the numerator or the money back would be your revenue. However, your company generates revenue is the numerator in the formula. And the money that you give to somebody, the dollar, is going to be your sales and marketing expense. And so if I was your fractional CFO or anybody's fractional CFO, one of the questions I would want to answer is, if any given month, let's say you made $100, and I look at your sales and marketing expense, I'm going to oversimplify it, and you spent a total of $10. Well, that's a 10-to-1 ROI. That's great. Like, what were the things that you did to spend that expense on, and should we do more of it? Because once we understand what's driving your revenue and how much you're spending in order to gain that revenue, you can start making a whole host of decisions. A very valuable decision would be, let's say you have an entire host of affiliates that you work with, and you want to start giving them commissions or a percentage of any new business that they bring to you. Well, if you know that 10-to-1, now you know what your guardrails are of how much you can give to them and continue to be profitable on that revenue. We answer questions like that for our clients on a regular basis.
So I guess in my own limited knowledge of running businesses, we have few clients, right? Those numbers that you're talking about that I can do a 10-to-1 because I have 100 clients or 1,000 clients, and adding new ones, I might add 10 a day. And so I can easily calculate, because I'm a software as a service, this, Facebook being a cheesy example, but they have 100,000 chances every day for someone to sign up. But in my case, I might get 5 new clients a year. And so those numbers get really weird. What worked? I don't know. I don't know what brought that guy through the door. But I mean, I can go ask him because he's just a dude. But it's a different thing. I don't have as many at bats and maybe that's just nature of my business. Well, of course, it's nature of my business versus a software as a service where I have thousands and hundreds of thousands of users. But does that change those calculations at all, or do these only apply? Does that? I mean, 10-to-1 or 5-to-1. I mean, I'm lucky enough. I give $1 and I get $1.20 back. Right? That's the world of services. As opposed to Facebook, where I give $1 and I get $1,000 back, or Google.
Well, so great question. So I would say the first answer is yes, the formula changes. So in addition to doing month to month, I would do a trailing 6 and I would do a trailing 12 month, which is what we generally do for early stage companies, because the law of small numbers, you're going to get a lot of variability if your sample size is too small. And so one of the ways we control with that is trend analysis. Show me how I'm doing over time. But it also comes back to what you were saying earlier, is that if we're going to record revenue on any company's books, we're not going to lump everything together. On the contrary, we're going to have one line of business for your professional services, one line of business for Facebook, one line of business for affiliates. And then on the expense side, we're going to make best efforts to separate that expense and allocate it to the appropriate line of revenue so that we can answer those questions. Now, sometimes it's not that clean. It's harder.
Sure.
But this doesn't have to be exact per se. There's a degree of hand grenades in this. In fact, that's where I see a lot of founders need counseling. One of my biggest pieces of advice I can give any founder, if you had to choose how you spend your time more than anything else, it should be on top of the funnel and closing deals all day long. And it should be led by founders, until which time your sales and marketing machine or your sales and marketing function is a machine. That there is a degree of consistency of seeing the same or more count of leads at the top of the funnel, month in, month out, and closing deals. And what I see happen a lot of times is founders will continue to spend more money on features and functions. And they may be great features and functions, but they don't matter if you run out of cash.
Man, we have not had this conversation offline. So we build custom software for startups a lot of times. And one of the things that I hear a lot is, well, I need to add these features. They don't have, and these are generally pre-revenue. So the reason they have to in that question is doing a lot of heavy lifting, right? Who's telling you this? Unless it's, and this could be another $50,000 worth of development for these new features that you quote have to have, but no one knows what the ROI on that will be. And so oftentimes I tell them we shoot ourselves in the foot because we're telling, don't build that, even though you're killing our revenue because of that. But I want to think long-term, You don't know if this works. So get it out the door, and then let's see what people say. Because founders have in their mind that I need all of this stuff.
That's right.
And it's like painting your house. It's a lot of money. Unless you just really love the color, you're never getting that money back. You know what I'm saying? You don't build that feature just because you really you wanted to do this cool quote engine where every time I come in, it gives you a new fancy quote from some famous person every day to inspire you. Man.
Oh, there's so much we can unpack there. So in no particular order, when all you have is a hammer, everything looks like a nail. And so most of us, myself included, I mean, I'm accounting and finance. I'm not sales and marketing. Everything I know in sales and marketing, I've had to either learn by trial and error or just find other people. Today, I'll tell you, who I'm a gigantic fan of is Alex Hormozi.
How funny. We were just talking about him, Gary.
Alex is sharp. He knows his stuff. My opinion.
He needs to shave and put on some clothes. That's other than that.
Oh, is that the book that you were talking about?
Yeah, I just bought his book. So, I mean, it's kind of apropos. Anyway.
It's, I'll just use it as an example. Obviously, lots of great books out there, but $100 million offers, $100 million leads, very small investment for a phenomenal education in how to convey value, how to fill the top of the funnel. And so big endorsement, at least from me. But, that's a new set of skills. It requires overcoming inertia. And when you're an early stage, when you're a founder and you have a lot to do, trying to tell a founder, I know you love your product, but you gotta put your desire to roll out more features and functions aside, and get dollars in the door. And the way you're going to do that is not only closing people, but the second item I've learned is you have to ask for the sale. Because one of the things I've also learned is, for better or for worse, people will generally pay you lip service. And as I tell my daughters, watch what the boys do, not what they say. What does that mean? That means, well, you can tell me all day long you like what I've got, but are you willing to give me money?
Mm-hmm. Yeah, I've said when I do mentoring and stuff like that, it's like charge $1. Find something that makes them pull the credit card out of the wallet. Because that means a 10,000, even if it's $1, it doesn't matter. It's the transactional relationship that has to be built. Mm-hmm. If I'm willing to give you $1, that doesn't just mean the money. It means you're trustworthy enough for me to trust you that I'm going to give you my credit card, that you're not going to run away and just start charging and gambling away my money, right? It's a relationship that I've given. If my daughter who's 15 loves Sheen. And what's the other one? Gary, do you know the other one? It starts with a T. Tenmo? No. Is that right?
Are you asking me because I have daughters? Or are you trying to say something? Okay.
No, I'm not trying to.
I have no idea what you're even talking about. What is Sheen?
Really?
Is it a makeup brand?
No, Sheen and I think it's Timo. It doesn't matter. They are Chinese manufacturers.
Oh, they're
create fast fashion. I mean, you buying a shirt for $6.
Yeah,
Temu.
I've heard of Temu.
Yeah, that's the one. She loves those. And I'm like, girl, I'm not giving them my credit card, period. No, you can do, she has a little debit card that we gave her. You want to put that there. It's only got a certain amount of money on it. You want to put that in there, fine. But I am not giving them access to mine because I don't trust anything coming out of that company. And they were, a multi-million-dollar brand. I just know. But that $1 just says so much. It's not, yeah, man. How many times, Gary, have we heard, if I just build this thing, I have 3 investors ready to go.
Oh yeah.
It happens.
Almost every startup that we've worked with has a similar scenario where they're on the verge. They just have to make sure that they do this, this, and this, and then throw in this, and then change that.
So said another way, getting cash in exchange is validation that you're on the right track. And my experience has been that, until you can see some consistency, your time is better spent selling and marketing than it is continuing to hone a product. Presuming, you have an MVP that you can get out. You can at least get out there.
You can at least sell something.
Big Pixel builds world-class custom software and amazing apps. Our team of pros puts passion into every one of our projects. Our design-infused development leans heavily on delivering a great experience for our clients and their clients. From startups to enterprises, we can help craft your ideas into real-world products that help your business do better business.
I want to change gears again because I have a question I've been sitting in the back of my mind. So you've been doing this for a little over 7 years, according to my sheets in front of me.
Yep.
How has the world changed in 7 years for finance and accounting and all? I mean, you've lived now through, the pandemic, crypto, now AI land, high interest rates. You've lived through low interest rates. How is it different now as opposed to even 2 years ago?
Especially when it comes to investments and investors.
Yeah. So, I mean, fun, great subject that I'm happy to unpack. And actually goes back further than that. I was around for the dot-com boom in the late 90s.
So was David.
Oh,
I remember sitting next to a guy who was making $400,000 a month. And I'm thinking to myself, what is going on here? So phenomenal education, a little bit of backdrop, or background, I think would be helpful context. So next year we'll mark 2 decades as an investing professional. So I have a designation. It's called the CFA, Chartered Financial Analyst. Somewhat equivalent to an MBA, a whole host of disciplines, heavy emphasis on portfolio management, but includes accounting and finance, equities, bonds, derivatives, take your pick, anything in the investing world. I've made the decision to marry that with wearing a fractional CFO hat. So when I started FinStrat back in Jan of 2017, I was serving as a fractional CFO, and I used the experience that I had previously as a founder and a CFO to assist our clients, many of whom have cumulatively closed over $100 million in debt and equity financing and have sold their business. And so just context. That said, what's changed? Three things in particular that come to mind in no particular order. Number one is just access for information. Obviously, everyone appreciates, maybe they don't appreciate, the ready access they have to information via the internet. Said another way, the cost to start a business has never been lower.
Yeah,
and just
sure.
just a quick context. Henry Ford, everyone knows who started Ford Motor. He used to have a room next to his office with, dozens of professionals who was effectively his Google. He would want to know something, and he would send someone over there and say, find out for me how iron coke is made. And people would go and they'd figure out how, he'd get an answer maybe a day or 2 or 3 later.
Mm-hmm.
Today,
that's crazy.
Today, you and I can just in a matter of seconds have, a base knowledge of how that works. So that's number one. Number two, for better or for worse, interest rates absolutely, or it's to say how expensive or inexpensive money is, has an influence on risk, which has an influence on what people invest in. Probably it's a larger conversation, but my sense is that we're near the end of a debt super cycle that started.
What does that mean?
Many, many decades ago. So if you think about when you borrow money, you have to pay interest. The amount of interest you pay is going to depend on a whole host of factors. But I'll keep it simple for now and say that it's set by the Federal Reserve. And for a very long time, rates have been near zero.
Yeah.
And now they're not. Now they're at near a 20-year high. And that has consequences. It has consequences in what people can afford, what banks will lend on mortgages, what venture capital firms will lend to companies. And the concept of a debt supercycle is that everyone kind of says, well, the government will always print more money. And there's some truth to that. But you have to ask the question, well, does it ever come to an end? And the answer is it does come to an end. Well, when does it come to an end? Very, very objective answer. Well, the objective answer is that for all of the debt that the government publishes, it not only has to repay the principal, but the interest. And as interest rates get bigger, or if you have more debt out there, you come a point where you don't have enough revenue to support your interest payments.
Mm-hmm.
Unless you just print money, in which case you have very bad inflation because there's no commensurate productivity associated with those dollars. And again, I'll oversimplify this and just say, what is a dollar? A dollar is intended to represent productivity, which is why there used to be a gold standard. The only reason you can print money is because there was blood, sweat, and tears associated with pulling gold out of the ground. When Nixon completely got us off the gold standard back in the 70s, what prevents the Federal Reserve from issuing as much debt as they want? Really, it's just Congress in terms of spending. But they have a whole host of monetary levers at their disposal that basically gives them free rein to print money. I'm oversimplifying it. But from where I sit, this is coming to an end. It's coming to an end because we live in a world of cause and effect. And just for sake of example, if tomorrow the dollar cracked, I'm not saying it's going to, because that's going to bring us to number 3. But if the dollar cracked, the Fed would be forced to raise rates more. Well, if they raise rates more, what's going to happen to just lending in general? It'll continue to contract, and you'll see a slowdown. Consequently, if bonds sold off, because Japan or China or the rest of the world says, you know what, US, I don't like your financial profile. I'm not buying any more of your debt. What would have to happen? The Fed would have to start raising rates even more in order to attract buyers of that debt, because they have a whole host of expenses: Social Security, Medicare, defense, and a whole host of other industries. My sense is that we're coming towards the end of what has been 20 years of cheap money. That is the effect of getting the US off of the gold standard in the 70s. And that higher rates are here to stay. And we've not yet worked their way. The full consequence of getting all that debt has not made its way out of the system yet. And before they do, there are going to be a lot of asset classes that are going to take it on its chin. There'll be other mitigating factors. Commercial real estate's a great example. COVID has put everybody in the home. Commercial real estate sector has not been successful. And
yeah, I have a friend who he buys big buildings. He said, I just bought 100,000 square foot buildings, like four stories, not a high rise or something. And he said it was built 6 years ago, something like that, for $300 a square foot. He says, I just stole it from this guy. And he didn't have a choice. It's just the economy. He's like, I didn't do anything bad here, but I'm basically robbing him. I paid $100 a square foot. Yeah. And he's like, this is coming. And he's telling everybody, don't build right now.
And so who was the bank who financed that building at $300 a square foot? And what happened to their balance sheet? Do you think they're going to?
They got crushed.
They got crushed. And so it's just this bigger understanding is look, we do live in a world of cause and effect. Sometimes my sense is we forget that. But anyway, that was number 2. Number 3, the final one is, here's why I'm not a perma bear, or people who consistently say the sky is falling. I'm uber bullish on artificial intelligence. And I genuinely believe it's a tremendous tailwind for the overall wealth of the United States and developed nations who are going to start leveraging it. I say that because, one of the things that separates the USA from Italy, just for sake of example, is the fact that we put such an emphasis on technology. Technology is just a synonym for productivity. It's created wealth more than any time in recorded history, as compared to a country like Italy. Now, I love Italy. I've been there a bunch. I've loved all the Italians I've ever interacted with, but a significant portion of their GDP is based on tourism.
Mm-hmm.
Well, all the AI in the world can't get more people to visit your country. I mean, you may be able to siphon more people from France or Greece because you got better marketing, but there's a limit. And so we now need to ask ourselves, well, what is the productivity impact that artificial intelligence is going to have on a typical American worker? My own personal experience is significant. There are things I can do today that took me twice the amount of time. Multiply that by
For
all
sure.
the professionals in this country, and we're only a year in. We haven't seen anything yet.
So you are not afraid of the digital overlords?
I'm not. No. I mean, I think it also depends on your time frame. And if we were to fast forward 100 years, based on some of the thing that I've read, maybe I am. But in the foreseeable future, no.
Because Gary and I talk about this. My whole company and I talk about this. It is so interesting because it's like the fear is that it's getting so much better, so much quicker that we're going to lose the leash, and there it goes. And now we can never get that back. And who knows where the end of that is. And that's and maybe I've seen too many Terminator movies. I don't know, but it's scary to me to a point. I mean, I love that there is a golden age between that point and Skynet, right? Where AI is just a helper. And we go through this radical change where we are able to be so productive. We all have superpowers for all intents and purposes before any of the bad stuff happens. I'm not sure I will be alive even if the bad stuff does happen, but it's scary to me because what we don't know is how fast it can actually move. Because the fact that, I mean, if you look at ChatGPT a year ago, their birthday was just a little while ago. What they started at when we first got it, we all made fun of it because it lied all the time, to what it can do now, or the easier ones are the image generators. If you look at the original image generators, I mean, Gary uses these things all the time. That's how we do all our work. He doesn't actually do any real work.
That's not true. Don't say that.
But when there's actually a website that does the same thing. I think it's something like, make me a party, an intergenerational, multiracial party at a dog park is the prompt that they've been giving like every month to watch these things change. And you look at the ones from a year ago, I mean, it's creepy zombie people, right? Their mouths are all weird. They have no fingers, right? It's all their eyes are all like all over the, and now there are parts of it that look amazing. The eyes are still kind of off, but it's amazing the growth. And that's what scares me is that was 1 year. I mean, you give it a decade, I don't see how we hold that leash anymore. I really don't.
So the way I think about it is artificial intelligence is a tool. Like any tool,
Yep.
it still needs a purpose. But just like when Ford introduced cars and replaced horses, it just created a new industry.
Mm-hmm.
And so if you wanted me to, procrastinate right now, I'd tell you, can I imagine that we now have an entire industry that's focused on mining asteroids or exploring the solar system? And that we're going to leverage AI to do a lot of the amazing computing that's going to take to solve so many of the problems that are in our way. Yeah. And people will be busy doing those things now. Whether or not there's any AI that ever gets away from us, I mean, it's conceivable, at least from what I've read on the subject, and I'm not an expert. We're many decades away from solving some of the bigger problems that would enable something that looked like Skynet or Terminator.
Well, Kristian, with your experience so far, what would you say are the top 3 pieces of advice that you would give a new entrepreneur, a new business, or a startup?
Let's see, top 3. Number 1 is going to be, if you're going to start a business, understand that all businesses fail for the same reason. It's they run out of cash. And so, said another way, if you're going to start a business, you have to answer the question, how can you start generating as much cash as soon as possible, or as quickly as possible? And one of the things that I've found is it's easier to start with something that resembles a service than it is a product. Again, there are exceptions, but a service is going to require less upfront capital and start to give you the opportunity to learn. Number 2, no one's going to care about your company as much as you do. And so I'm a very big proponent on people and in ensuring that they're smart and effective, giving them, in my case, all of the staff in my company have stock options. I think ownership is extremely valuable for a whole host of reasons. But at the end of the day, you need a chief hustle officer, someone who is going to roll up their sleeves and do what it takes to get done. If you have, that means working on the weekends, giving up your free time. And so that changes over time until you hit a critical mass. But in the beginning, you just know that it's going to be a significant time requirement. And then third is kind of going back to what we touched on before, in terms of focusing on sales. In the beginning, you really have to turn this machine on to get consistent in your ability to generate revenue. And once you see a critical mass that you're being consistent, is when I would say you can start asking questions like, all right, where do I want to take this company? Am I satisfied with the status quo, or do I want to start introducing other lines of business, or do I want to sell? And that kind of dovetails into, I can give you items 4, 5, and 6, but if you ask me just for 3 as a starting point, that's where I would go.
Awesome. Well
Definitely
thought
big
out.
pieces of this. The first one for sure. A lot of people, they will start and they'll have the passion, they'll have the drive, but they sometimes just throw caution to the wind and think like, as long as I work hard, the money will come. And then it doesn't always pan out that way for them. So
Yeah, I've always hated the advice of, if you treat your people well and you do a good job, that your success will follow. That's not true. I mean, it can be true and you want it to be true, but the simple fact of the matter is you keep going until you run out of money. And if you don't figure out how, I don't care how, I could treat my people wonderfully, but if I'm not taking care of my customers, or I'm not building a product that anyone cares about, the rest doesn't matter. I could love all I want. I could love NFTs more than anybody else, and it's still a crappy product. So,
Well, 100%. And that comes back to is someone willing to give you money? And because it's really just synonymous with what problem are you solving? And there's no debate, if someone's willing to hand you cash, that you're solving a problem that's worth solving. You and I, if the 3 of us here came up with a whole list of things that we would like to see done better, I'm sure we could spend hours. The question is are these any problems that people are willing to pay money for? And that's the litmus test, in my mind. Once you find what it is,
how many people too, not just a couple.
Well, exactly. And so what's your scale?
Yeah.
Not everyone is going to end up with a multi-billion-dollar business, but you can end up with $100 million business. We helped. Yeah. I mean, you're answering the question. Well, I'll leave this. It comes back to one of the big exercises we do is we always like to begin with the end in mind. What's your time horizon, and how much money would you like to make when this is all said and done after taxes? And once we know the answers to those questions, we can work backwards.
It's so funny you say that, because a lot of people say, if you ask someone that, if I ask a 10-year-old kid, how much money do you want at the end of all this? In a year from now, if you had to do X, Y, and Z, how much money would you want? And they would say $1,000, because that's all they can understand. Mm-hmm. But you ask my son, almost 18, how much money do you want? I want $18 bazillion. Mm-hmm. Okay. That's because you don't understand. It's the opposite side, because you're 18. But if you have a company, I've used this example a lot. If you've never taken money and you have a lifestyle business and it's making $1 million in revenue, you as a person are making a very nice life. You have a wonderful life that you're making a very nice salary and you're doing well. You took $1 million and you made that $1 million. You're still on ramen. You're still, because everyone's mad at you. Same revenue, but it's just a different perspective. Yeah. And I'm not saying one's right or wrong, but you need to know what you're going. And not everyone has the ability or the desire to run $1 billion company. That's a whole different beast.
That's right. And so a couple fun activities, if you ever want to do with your son, is have him go to the Forbes list of billionaires and have him cycle through the first 100 and ask him what he sees in terms of patterns, because there are patterns in there. And so, said another way, if you're starting a hot dog stand, you're not going to make $1 billion. But the people who are on that list didn't start a hot dog stand.
True.
And so, and that's just a fun exercise. But I agree with you. The other big thing I would leave with you, and this kind of comes back to the CFO, what we were talking about when I was using the example of ROI, understanding a set of financials, extremely valuable. Balance sheet, P&L, and cash flow statement. If we were to unpack the balance sheet, it's assets, liabilities, and equity. More specifically, assets equal liabilities plus equity. And if you think about an asset like everyone on this call presumably has as a home, you think about liabilities, your mortgage, that portion that the bank either asked you to put down when you bought it, and or that you've accumulated over time making your payments is your equity. That identical concept exists with a business. For example, why does Apple, with all of their cash, issue bonds in the open market? They sell bonds to investors. And they do it because they know that the amount of money they can make after they pay back interest to the people who buy their bonds is greater. They can generate additional yield. So it's this concept of leverage is really important. So like as you were pointing out, that if you have $1 million business and you bought $1 million, that's kind of 1-to-1. That's not phenomenal leverage. But if you borrow $1 million and create a $10 million business, now we're going with gas. And so just a great example you triggered, when I think about wearing a fractional CFO hat and having conversations, those are the types of things that we assist, highlight and unpack.
Well, Kristian, if anybody wants to connect with you or learn more about FinStrat, how can they get in touch with you?
Website is finstratmgmt.com. And if you Google consultation for any of your listeners who have a venture-backed company and they'd like to get a little bit of call time with one of our CFOs as a courtesy to your listeners, happy to extend that.
Awesome. Yeah, we'll put these links in the show notes too, so everybody will get access to them.
Well, thank you so much, Kristian, for joining us. This has been a lot of fun.
Likewise, I've been on a lot of podcasts, and I genuinely enjoy how you guys have made this fun and enjoyable.
Awesome.
Thank
I'll
you.
take it. Hear that, Gary? You
I
didn't
heard that.
screw it up this time.
Well, I was on mute most of the time because my dog was barking in the background. Because we're
Fair enough.
such professionals. No, I'm joking.
We are very professional. All righty, y'all. We're going to end this one. Thank you guys so much. We will talk to you next week.
See you guys.
Hi, I'm Christy Pronto, Content Marketing Director here at Big Pixel. Thank you for listening to this episode of the BizDev Podcast. We'd love to hear from you. Shoot us an email, hello@thebigpixel.net. The BizDev Podcast is produced and presented by Big Pixel. See you next week. Until then, follow us on Instagram, Twitter, Facebook, Threads, YouTube, and LinkedIn.